In our strategy, we operate with a 5-phase cycle framework. We are not predicting headlines. We are tracking pressure, sequencing, and confirmation. That distinction matters late in the cycle. This conversation is not really about BlackRock. It is about what happens when private credit math stops working. That tends to show up quietly, and usually later than most expect. We are reviewing a discussion focused on multifamily credit stress. The original video walks through deal-level mechanics and lender behavior. Our role is to translate that into our strategy framework. The original is worth watching for full detail. The core claim is simple. Large institutional investors are now marking down private credit exposure. These are not small players, and they are usually late to acknowledge losses. Private credit sits outside the traditional banking system. It is flexible, less transparent, and institutionally funded. That works well in expansion. It becomes fragile when refinancing assumptions fail. For several years, loans were carried as if conditions would normalize, rates were expected to fall, cash flow was expected to recover. That expectation has not been confirmed. Higher rates reduce cash flow. Higher expenses reduce cash flow. Flat rents reduce cash flow. Eventually, the spreadsheet reaches a hard stop. A large wave of new multifamily supply came online that shifted power toward renters. Occupancy softened in many markets. Concessions increased. The real stress shows up at loan maturity. Loans must be resized to current values. When values are lower, equity is erased. Sponsors are forced to add capital or lose the asset. This is not a household-driven housing crisis. Banks are not failing at scale. Losses are being absorbed by institutions. That changes how stress transmits. In our strategy, this is a credit signal first. Specifically, private credit and commercial real estate. It also touches liquidity and refinancing conditions. It is not yet a consumer demand signal. This aligns with late Phase 1 moving toward Phase 2 pressure. Stress is visible but not yet cascading. Confirmation requires broader credit tightening. We focus on sequencing, not drama. The probability of forced asset sales increases. Weak sponsors face shorter timelines. Dispersion across markets and operators widens. Leverage becomes the defining risk. This does not imply a systemic collapse. It does not require abandoning discipline. It does not eliminate the role of liquidity, and it does not reward rushing decisions. If this kind of signal-based framing is useful, subscribing helps you stay grounded as conditions change. We focus on process, not predictions. That consistency matters most late in the cycle. Quick note before we continue. This is educational commentary only. It is not financial advice. Large asset managers tend to acknowledge losses late. They do not rush to mark assets down. When they do, it confirms internal pressure. That is the signal we care about. Base case is continued slow stress in weak assets. An alternate case is faster repricing as maturities cluster. Tail risk increases only if funding spreads widen broadly. We track confirmation, not fear. Private credit fund write-downs, multifamily delinquency trends, commercial loan maturity volumes, credit spreads, and refinancing activity. We do not need to predict bottoms. We need to recognize when stress becomes forced. That is where opportunity eventually forms. We do not need to be early. We just cannot afford to be late.